Good morning. It is Tuesday, June the 2nd. Here's what's on the agenda. Alphabet's blockbuster $80 billion equity raise to fund AI. A mixed picture on stock futures after an 8-day rally for the S&P, and a split-screen moment as Trump talks up an Iran deal again, as Tehran says talks have been suspended.
Meanwhile then, in the markets, in the numbers, Tom, European equity futures are pointing higher, but some of this is a catch-up story to the US yesterday. The US rallied quite a lot after European close yesterday, so we need to factor that in. So we are expecting to see positivity on European equity markets, not so on the Kospi, and this has been a really volatile index over the last hour or so. It was firmly in negative territory earlier on. We were thinking about profit-taking on the AI story. Then it popped up into the green, now down 0.3%. It's that kind of messaging that seems to have been weighing on the Nasdaq futures overnight, so there is some weakness in the session for the US ahead at this point. Brent crude being whipsawed, as have yields been whipsawed by all of those conflicting lines that Tom was just talking about coming out of the Middle East. We'll get to that shortly. The countdown to the opening trade starts right now.
2nd, good morning. You've heard of de-equitization. We've heard that a lot over the last few years. Now we're getting into the re-equitization phase. SpaceX, Anthropic, OpenAI, and now Alphabet, all coming to the market and in size. The Alphabet story is fascinating, coming to the market with $80 billion in terms of a capital raise through the equity market. 40 of that is at the money, i.e. they're going straight to retail, which I think is fascinating in itself. 10's going to Greg Abel over at Berkshire Hathaway, 30 split, the remaining 30 split into two tranches. Why are they going at the money? Why are they going to retail? Tom talked about the fact that some of it's going to build out the OpenAI story. Some of it's also going to pay a tax bill. That's interesting too. So there's a lot going on here. But re-equitization, there are some big lumps of equity coming back into this market.
This from a company that investors had gotten used to in terms of repurchases, in terms of a balance sheet that was a fortress, the fortress balance sheet of Alphabet, repurchases. That has all changed on this huge bet around AI infrastructure and the demand for their TPUs. And in terms of that 80 billion number, that is almost comparable to the capex spend of 2025 from Alphabet. Bloomberg Intelligence now looking at that $80 billion equity number and pushing that out and doing some analysis in terms of what that tells us about their future capex spend. So they pledged $190 billion of capex this year. And Bloomberg Intelligence suggesting this could put them on course for $300 billion by 2027.
And this is just one company. This is really quite incredible numbers we're talking about. This is one of the biggest. If you put that package of complexity together around Alphabet, it's one of the biggest equity raises that we have ever seen. And it's a sort of unexpected twist in the IPO narrative and the money-raising narrative that we were going to be talking about already this year. But here are some existing, already listed companies coming back to the market for more. Let's talk about the other part of this morning, which is Anthropic, moving ahead of OpenAI in the race to IPO, if it is a race. I mean, do you want to go first? Do you want to go second? I've read both sides of the argument this morning.
Going first and going second, I think, is an interesting question. But then you've also got to look below the hood and look at what the lockups are going to look like. How staggered? When do we get the big kind of lockup expiries? What impact could that have further down the road? There's a lot of equity coming into the market. So the initial kind of amount of stock coming to the market could be relatively small. But further down the road, 6 months, a year, whatever it's going to likely look like, you are going to get a lot of equity coming through. And what is this going to be used for? Just back to the Google story, I think it's interesting that 40 is going to be used effectively for stock compensation. That's what they're changing their strategy on stock compensation. So in some ways, again, the Alphabet story is about an exit. The OpenAI story is about an exit. The Anthropic story is about an exit. The SpaceX story is about an exit. There are a lot of people who have got a lot of value in these businesses looking to offload it into a wider market and potentially into 401ks, into ETFs. That is what is effectively happening here.
This is a huge amount. This is a huge amount of liquidity. This is a huge amount for the markets to absorb in terms of debt and in terms of equity. The two stories can be tied together because what Alphabet may be looking at is the kind of revenue that's being driven by the likes of Anthropic. They are on course for their most recent quarter potentially to bring in revenues of 11 billion, close to 11 billion US dollars, double the previous quarter, and according to Bloomberg reporting, getting close to profitability. So they are seeing that demand from their enterprise clients. So the demand is being crystallized. those corporates and those CFOs are signing off on buying in Anthropic. And that potentially is another signal for Alphabet that this demand is there. They need to build the infrastructure to meet it on their end.
Yes, let's draw a line between this conversation then and then what we're seeing in the wider market story. Because on the one hand, we are whipsawed by the Iran headlines. On the other, we are still buying into the AI growth story. A little bit wobbly this morning, perhaps. US futures pointing lower. The Kospi quite volatile. It's in a bit of profit taking. But we have come so far on that story. And it's interesting to think about the wider economic signals that we're getting around AI. I was looking at the US ISM data, the strongest in 4 years, and AI is part of that. Yes, there were tax changes that incentivized some investment. There's a reduction in trade uncertainty also. But there is also the AI build-out, and that's a key factor there. CPI out of Korea, one of our colleagues over at in Bloomberg TV in Asia talking about, if you're getting structural, quote-unquote, demand for memory, are you also going to get a structural change in the inflation picture in Korea? So that's part of the narrative there. And HP up 27% after hours, as that's another name that's, increasingly we're talking about once again, coming back from the past, if you like, but for demand for servers, demand for networking, and the S&P up for the 8th day.
The inflation rate within the AI story is extraordinary. And if it is structural, then you have to make assumptions going forward in terms of what that's going to mean for the real economy. But the fact that memory chips are priced in the way that they are at the moment, that has to have an impact on the cost of AI for the users that we all think are ultimately going to drive this and pay the right price and use this stuff in the productivity miracle that we're all anticipating. How much does the productivity miracle cost if this is what a chip costs and the inflation rate within that chip space is X plus whatever?
Economists seem to suggest at the moment that this isn't a big enough item in the basket to really move the needle. But is that going to stay the case?
Yeah, and there's a lot of discussion in San Francisco and beyond about token budgets and the fact that companies are burning through these budgets that they may have set in 2025 for 2026. Then you have agentic AI, and they're burning through those budgets as their employees use this agentic service. And so that is an additional cost for them. And at what point does that become too much of a cost for them, or do they have to restructure their budgets?
It has to have a revenue benefit, doesn't it? It has to generate productivity, and if it's not, then it's a cost. And that needs to be, that's what you've got to resolve. So there's a pricing issue with AI that needs to, you need to find a balance there.
So that's the inflationary impulse coming through from AI. And to your point, we're seeing that percolating through different data sets and different regions. We also have to continue, of course, to focus on what's happening with the commodity space. And oil, just a little weaker today, but very volatile yesterday. A big tick up, in fact, the biggest jump in about a month yesterday. After you had, number one, you had further incursions by Israel into Lebanon. We know that Iran has put that as a potential red line for them in terms of signing off this deal. And then you had the Iranians suggesting that they were going to suspend conversations with the US. But no problem, because President Trump comes out in an interview with US media and says we could still get a deal within the week. So we described this in the headlines as a split screen moment. That's what it feels like. And how do the markets work around that? How do investors work around that?
How do you price this? Like distribution of outcomes. Kind of, I don't know. I don't know. Do you put it on a kind of what does the bottom axis look like? How do you think about time in this? We're going to have a guest on a little bit later who's going to say, oh yeah, it's going to get fixed by July. Who knows? So I don't know how you put the time factor into the price.
Yes, and does the round number of 100 matter? Does it matter to many people? Does it matter to the president in the US? Does that, maybe not, maybe gas prices matter more. But some people are asking, if you're edging back up towards 100, we're at 94, that's the handle this morning. But if you head up back to 100, and if you've got yields going higher on bonds, does that start to influence once again, and if inventories are much reduced, does that start to influence once again the stock story, which has been pretty immune because of AI?
So do we need to see Brent above $100? Do we need to see yields shooting up on the 10-year? And do we need to see equities and US stocks selling off? So far, that hasn't happened, of course, in the equity space, to pressure Trump to making some concessions to this deal across the line. Does the relative resilience of the equity market keep the straight close for longer?
Yeah.
Potentially. Flavio Carpenzano, Capital Group Investment Director, is going to be joining us to discuss all of this, as will Shanti Kelemen, 7IM co-CIO, Angelina Valavina, Fitch Ratings EMEA Natural Resources Head, will be here to talk about how you price oil right now and think about when we are going to see a straight reopening and what that ultimately looks like, Tom.
Here's what else we are watching then throughout the day. 10 a.m. UK time, we're going to get Euro area CPI. Talking of inflation, that data breaking at 10. 2 p.m. UK time, we're going to be hearing from the Bank of England Governor Andrew Bailey, appearing before the House of Lords Economic Affairs Committee. And at 3 p.m. UK time, we get US JOLTS data ahead, of course, of non-farm payrolls, which drop on Friday. US congressional primary elections are held in California, Iowa, Montana, New Jersey, New Mexico and South Dakota. Plus, Israel and Lebanon resume talks in Washington, D.C. after President Trump held that phone call, according to Axios, very contentious with Prime Minister Netanyahu, and apparently convinced him to stop attacks on Beirut.
Some quite incredible language apparently being used in that call. Anyway, diplomacy. What else do you need to know this Tuesday morning? Denmark's Prime Minister Mette Frederiksen will remain in power for a third term after a breakthrough in coalition talks. Frederiksen said she succeeded in forging a centre-left four-party coalition. It comes more than 2 months after a closely fought election. That is the longest time it has taken to form a cabinet in Danish history. The White House says it will reduce tariffs on agricultural equipment to cut costs for US farmers and manufacturers. Levies on equipment such as combines, combine harvesters, will drop to 50%. It was 25%. The change will come into force on June the 8th and last through to the end of next year. And it's raining outside, which is great, because here in London we've also got significant travel disruption caused, and it starts today, by a tube strike. Some of the drivers on the city's underground train network are preparing to strike. I think they are already on strike in a dispute over working hours. The walkouts will go ahead all day today and again on Thursday. No service expected on the Circle Line, the Piccadilly Line and on parts of the Metropolitan and the Central Lines. Other tube lines will be running alongside the Elizabeth Line, the London Overground and the buses.
Well, we all made it in. Let's see how we get home. Coming up on the programme, it is 11 minutes past 7 here in London. We will get back to the geopolitics. Bloomberg learns that Russia's finance officials are warning Vladimir Putin that his spending on the war in Ukraine is becoming unaffordable. We will bring you the details later in the programme. Plus, ARM CEO Rene Haas has been speaking to Bloomberg from the Computex event, which has been taking place with much fanfare in Taiwan. We will bring you some of that interview in just a moment. We will also be joined next by Elliot Hentov, who is head of macro policy research at State Street Global Advisors. We'll try and put some of these themes we've been discussing together this morning. If you want to do that with us, IB plus BBTV Go is the function to use to get in touch with the team that puts together this programme. This is Bloomberg. Welcome back, everybody. This is the opening trade, 15 minutes past 7 here in London. And European equity market futures looking to play catch-up with their US counterparts from yesterday. And as US futures improve just a little, looking for some upside at the start of the trading day. Tom, the AI story, front and centre.
Yes, let's get back to a key player within the AI space, of course, focused on CPUs now as well. ARM CEO Rene Haas says he expects the balance of supply and demand for every type of memory chip across the board to remain tight for a while. Bloomberg's Stephen Engel spoke to him exclusively on the sidelines of the Computex conference in Taipei about the squeeze on the market, his view on the growth potential of AI and more.
I would say one thing that's different about what we're seeing right now is the amount of compute that artificial intelligence requires is quite significant to anything before it, and it touches every single industry. It touches everything around humanity. Everyone on the planet will have some interaction with AI, whether that's AI indirectly or directly, but it affects everyone. If you think about world GDP, $130 trillion, knowledge work, white-collar work being maybe a $30 trillion market, that is a large market of which today is largely undertapped. So is memory going to be short till 2030? I don't know. I hope not. But could I see this demand continuing much longer than people have ever seen historically? That I do believe.
So do you maybe look back at 2023 and there wasn't enough investment because a lot of memory chip makers were having trouble?
Absolutely.
They just didn't build in that capacity or foresee the demand that was going to shoot through the roof like it is now.
The folks at Micron, Samsung, SK Hynix, they have tough jobs. And in 2022, 2023, they're all losing money. And
now they're in the $1 trillion valuation
now
club.
They're the $1 trillion club, but cautious, right? Because they look at that and say, if I overbuild, where will I be when the supply crunch eases up? But I do think you may see some more innovative business models. Would hyperscalers be investing in fabs? Would there be more equity partnerships around that, such as secure supply? I think that's quite possible.
Well, yeah, so what kind of resiliency needs to be built into the system so you don't have such peaks and troughs?
There needs to be a shared system, right? Shared risk, shared investment and shared risk. I think asking public companies like a Micron to take all of that risk themselves with no shared risk from the people who are the large consumers, that's very, very hard to sustain. The governments have been helping. I mean, the U.S. government has helped in terms of the work they've been doing with Micron and also encouraging Samsung and Hynix to expand the U.S. But I think it's more than just government.
Okay, Bloomberg's Stephen Engel speaking exclusively to Rene Haas, the CEO of Arm in Taipei, of course, on the sidelines of Computex. I was trying to work out whether Rene Haas was suggesting that the memory chip story is now not cyclical. And I'm not sure if that's exactly what he was saying, but he was saying that they're seeing demand that they haven't seen previously and the length of demand. So certainly in the years ahead, he wasn't committing to 2030s and beyond, but he certainly said longer than we've seen previously in terms of that demand story.
But he's saying that the companies like SK Hynix and Samsung are still worried that it's cyclical.
Yes.
And that's the fear that still exists. But he's also talking about almost socializing the risk around that and how you build that out and who takes the risk. And maybe it's not just those individual companies, it's the wider ecosystem. Maybe you include government within that wider ecosystem.
Yeah.
Are we at the point now where the risk is so great that ultimately you have to have a wider base for that pyramid?
The risk to stocks, certainly, but I'm not sure that's quite the conversation. But yeah, really interesting thought to pursue. In that context, in that light, let's just have a moment to think about ST Micro this morning. In the light of continued strong AI infrastructure-led demand, I'm reading from their statement, and based on recent progress made on capacity run-up, ST Micro is raising its revenue ambition for data centres. The numbers here are not enormous by global standards, but certainly for Europe, this could be something that adds...
For Europe.
Yeah.
That's the... For Europe, this is quite big.
Yeah.
For the rest of the world, not so much.
And talking about data centre revenue doubling in 2027. So there we go, some more signs of positivity.
Elliot Hentov is joining us around the table this morning. He's the head of macro policy research at State Street Global Advisors. We appreciate you being here. Always a challenge to get in on a day like today, and it's raining outside. Let's start with the AI story. You've got SpaceX coming to the market. You've got Anthropic, OpenAI. You've got Google overnight talking about raising $80 billion. We've had years of de-equitization of share buybacks, big drivers of the market. Feels like that's going into reverse. What are the implications?
First of all, I don't think it's going into reverse.
Okay.
I do not think this is the end of the 25-year cycle of kind of a de-equitization. I think we're in a plateau. The second thing is IPOs are generally not harbinger of great returns. So the correlation, the track record is poor, and one can wonder why is that. There's different theories, hypotheses that it kind of signals the top of the market. It signals kind of the cash out of the.
What do you think?
Well, I do think some of these business models are going to struggle. I think the hard part for investors is to figure out which one is actually going to thrive and succeed.
Any ideas?
I think what I do think is, as a macro researcher, I pay attention to that now.
Yeah,
I have to.
Precisely. So these are so big.
They're so big, and OpenAI's business model has repercussions for the whole CapEx cycle, which basically messes up or influences my macro outlook. So I have to pay attention to what's happening in private equity, so to speak, to get my forecasts right, too.
You have to pay attention to what's happening in space and to what's happening in Chinese robotics. I mean, being a macro tourist everywhere is getting to be a complicated business. We started this programme thinking about AI, also thinking about the role that the Iran war is playing and what is going to bring sufficient pressure to bear, perhaps from a market perspective, on the protagonists involved to bring about some resolution. Now, do you think it's something that markets can do? Is it something that oil and bond markets, stock markets do? Is it what oil inventories do that will bring this pressure to find a resolution?
I mean, the nice thing is we all have gotten a great economics lesson the last 2-3 months in how a supply shock unfolds, how it transmits. So you get the signal from the commodity markets, it spills over into inflation forecasts, bond markets adjust, and that's how you get the pressure on policy. That was the case in 2025 with tariffs. I think that's still the case this year. It's basically ultimately the bond market will be the tool that really drives U.S. policy. And I think you're right. I think you need a squeeze. You need something to crack to kind of to break the deadlock in the negotiations.
But then when we get that breaking of the deadlock and we get some kind of deal, we had a conversation yesterday with a geopolitics guest who was talking about the possibility of a muddy deal. Do we then enter a phase where we just worry about this restarting again? Not necessarily the war, but reclosing the Strait of Hormuz now becomes a tool that certain players think they can return to.
Yes, and we worry about it, but that's fine because we know how to do that. That's a risk premium. We bake it into asset prices, and the world moves on. As long as the physical molecules are flowing, that worries me much less. But yes, that is the world. There will be a residual risk premium. There will be a much higher floor on oil. That also affects the fact that we won't get as much of a disinflationary bust from a deal that comes out of the Iran war. So those are the consequences. I think that's precisely the world. We're not going to get a kumbaya moment. It will be a muddy deal. But muddy deal is what we're looking for versus muddy non-deal, which is what we have right now.
Is there a residual impact on margins then, even if this is cleared up with a muddy deal? And where does that land? How much has that been priced in? How do we think about the margin squeeze? Even as we look at Brent at, $94 a barrel, some have predicted $200 a barrel at the start of this conflict. Do we still continue to worry about margins and the squeeze there?
Depends whose margins. I think for the AI story, it's probably peripheral. For the non-AI story, I do think precisely it's a higher cost, higher input. It does eat at margins everywhere, particularly the ones that are energy intensive or high energy importers. Those margins in those markets will suffer as a result. And also the other thing is higher cost of financing. We're not going back to bond yields in February. We're probably going to go a little bit lower than where they are today. But that's still kind of a permanent kind of bump up in the cost of financing. That's
structurally higher yields?
Correct.
Over what period of time?
Well, if really, we're in a new decade. It's been since the 2020s. It's one supply shock after another, some big, some small. But basically, we have not reached the final end point, the final range point for where yields land.
What can't you price at the moment? You could price a muddy deal. What are you struggling to price right now?
Well, you say you can price the muddy deal. I think it's very hard to price it because a muddy deal in June is very different than a muddy deal in July. In August, when we did our initial forecasts at the beginning of this year, we expected rate cuts. And by March, we still held to that view because we thought, OK, maybe this could kind of resolve itself by April. But then each subsequent month changes the forecast. So the timing matters. It's not just about we cannot price. Currently, we're all in Groundhog Day. I think we mentioned that. Every day we wake up.
We're living it. Don't worry.
We wake up every day. And deal or no deal, and the timing really matters because that shifts everything. It shifts where bond yields land, and it shifts where our inflation forecasts land, and so forth.
And with all of that in mind, and the uncertainty and the lack of visibility, where do you think the Fed goes next? You don't think they move this year. You think they're on hold. But then when they do move, in which direction?
That's a great question. I think intuitively, if you looked at the economy just right now, you'd think it would be a step down once you get over that mild stagflationary hit. Digging a little bit deeper, if you think there's going to be a growth revival by 2027, tighter labor markets, you have stickier inflation in the service sector, probably the step could actually be up.
Are you saying that the US economy is reaccelerating?
It will after this is over.
OK.
What kind of reacceleration are we talking about?
They've already... I mean, the growth rates are already pretty robust, and I think that it'll be a mild plus. We're not talking about a huge step.
We've got non-farm payrolls on Friday. You're not worried about jobs and AI disruption of jobs?
AI disruption of jobs I'm not worried about. I am worried about jobs because there was a softening generally. We think some of the factors that led to the softening, huge policy uncertainty last year, a tightening of the tariff regime, those come off, and therefore you get a little bit of a revival and a loosening. Assuming we have a muddy deal that we can all finally move on with.
OK, the muddy deal. Elliot, thank you very much indeed. And thank you for braving the rain and the travel disruption for us, of course. Elliot Hentov, Head of Macro Policy Research at State Street Investment Management. Coming up, we're going to bring you the European bond market open with Capital Group Investment Director Flavio Carpenzano. This is Bloomberg.
It's the second. Good morning. How are you doing? 30 minutes to go until we start trading equities here in Europe. Futures are pretty positive right now. That's the picture we're looking at. 3, 4, 5, 6, 0.7%. I'm seeing on the screen. Looks like the Spanish market's going to have a good day today. So we are generally called higher. US futures are a little negative. Like, they're not down by a lot, 0.2%, nothing really to write home about. But there's a little bit of negativity maybe coming across the pond this morning.
Yes, there is a bit, isn't there? Although with the Kospi recovering, US futures, as you say, off earlier lows. So we'll watch that carefully. In terms of the bond market story, then, we actually see quite a lot of movement in the European bond market story, and it suggests less concern about inflation. But this is a bit yesterday's story, because we saw Treasury yields shoot up in the session and then come down on all of the mixed messaging we were getting coming out from the US, from Israel, from Iran, with regards to what is happening on the ground over in the Middle East and Lebanon and its role in particular. So perhaps we're just reflecting the dynamics yesterday in Treasury markets into the European session this morning. So we see some buying of fixed income. Let's get to the source of that volatility then in bond markets over the last 24 hours. Oil is ticking lower after its biggest gain in about a month. This as President Trump and Israeli Prime Minister Benjamin Netanyahu have offered differing accounts of a call about the fighting in Lebanon. Earlier, Iran said that Lebanon must be part of a broader peace deal. For more, let's bring in Bloomberg's Abir Abu Omar, who's in Dubai for us. Abir, very good to have you on the programme this morning to give us an update of what is happening here, because we get very different accounts from the US and from Israel, and to the extent that we're not entirely sure whether Iran and the US are still talking or exchanging messages. What can we be certain of?
Yeah, you're right. Good morning, Anna. So look, I mean, the latest we know is we have yet another conflicting sort of narrative between the United States, Israel, and Lebanon. So Lebanon has emerged as a sticking point in the wider negotiations between Iran and the United States. So what we know is that Axios reported earlier an expletive-laden call between President Trump and Prime Minister Benjamin Netanyahu yesterday. And President Trump came after and said that Israel had agreed to not raid the capital of Lebanon, Beirut. This is after Benjamin Netanyahu said that there were plans to send troops or to attack the suburbs in Beirut. Benjamin Netanyahu afterwards said that that Israel had agreed to not attack the suburbs of Beirut, but that the attacks on the southern part of the country will continue. So essentially, this is what's happening in Lebanon. Yesterday, we reported that Iran has said that Lebanon is a part of the negotiations, that it will suspend talks with the United States if attacks against Lebanon and Hezbollah, its ally in the southern part of Lebanon, continue. So it's emerged again as this point that has halted Iran from continuing its negotiations. Just a few minutes ago, the Iranian parliament speaker, Mohammad Ghalibaf, said that not only will the negotiations with the U.S. not carry on if the attacks against Lebanon don't stop, but that Iran will be forced to tackle the enemy, and I quote him here saying that. So aside from the fact that we're expecting this ceasefire agreement that will open up the Strait of Hormuz and continue the ongoing ceasefire for 60 days, that is sort of the preliminary deal between the two. What we know now is Lebanon, the nuclear enrichment program in Iran and sanctions and the frozen assets are going to be a big part of those conversations that will happen at a later stage. But for now, we're still waiting for this preliminary draft deal to happen between Iran, Israel, and the United States, essentially.
And Abir, we're getting some lines crossing from the semi-official Mer news agency in Iran, and they are citing a person apparently close to negotiations with the US, saying that Iran has not yet sent its latest text to the US. Iran is still deliberating on its final text, again, according to the semi-official Mer news agency. Do we know to what extent the leadership in Iran has coalesced around a position, Abir?
So look, again, this adds to the confusion to the confusion that we've been seeing over the past couple of days, and I'm just seeing this line coming up right now. But what we know is that the new supreme leader of Iran, Mujtaba Khamenei, or the new Khamenei, is against sending the enriched uranium outside. Now, what we know is Iran could reach some concessions about sending the enriched uranium or the highly enriched uranium to a third country. Some talks emerged about that being either Russia or China. But what we know for now is that the contention point for the time being is opening up the Strait of Hormuz. We know that Iran as well yesterday said that or threatened that another strait may be at risk here, and that is Bab el-Mandab, that is close to its Houthi allies in Yemen. And that is the strait that connects the Red Sea with the Gulf of Aden and the Indian Ocean, Tom. And that has been the waterway that Saudi Arabia has been using, for example, or resorting to divert away from the traffic in the Strait of Hormuz. So if that is under threat now, that's yet another risk to global energy prices that have been accelerating down slightly this morning. They were gaining yesterday after the talks emerged about Iran threatening to pause the negotiations with the U.S. until Lebanon is no longer attacked.
OK, Bloomberg's Abir Abu Amar in Dubai with that update. Thank you. Let's bring in at this point Flavio Carpenzano, Investment Director at Capital Group. Flavio, good morning. If the strait remains closed, to what extent is that priced into the bond markets? How much potential further pressure for upside yields is there at this point?
Yeah, first of all, thank you very much for having me here. Is of course a very fluid situation, so we don't know. The way is interesting. The way you can look at the bond market is like the market really focus on one side of the equation. This shock is clearly stagflationary, and they focus only on one side, which is inflation. That's why you saw this repricing in the bond market. What we think is important is cutting through the noise and see also the other side of the coin, which is growth. And growth in the U.S. so far has been robust, has been resilient. But again, we are going to have this week more data on the labor market. But our concern is that you can start to see more erosion in the real income, particularly in the low, middle part of the consumer in the U.S. So it's going to affect growth, and particularly because it's a different war compared to a few years ago. Saving rates in the U.S. is lower than in the past. It used to be 10, 12%. Today we talk about 6%. You see wage growth has been much lower. It used to be 6, 5%. Now it's more 3%. So when you combine all these together, the growth picture started to be a little bit risky. And that's why then when you look at the bond market with the Treasury at 4.5%, the 2 years at 4%, actually is quite attractive. And probably in terms of risk-reward, price more the inflation risk, doesn't price very well the downside risk. And you see the Fed actually, the market is pricing Fed potentially hike. We believe actually is going to hold and potentially cut at some point.
Very interesting. So you're really worried about growth for the details that you've just unpacked for us there. So that takes you to the long end of the curve. So you're finding opportunities at the long end of US Treasuries, but you're seeing opportunities in Japan and emerging markets as well.
So it's interesting. What we saw, we started the year more with underweight in the long end, and given valuation today in the U.S., we actually increased duration in the 10 years in the long end. When you look in the other part of the market, it's a different story. So Japan is an example where actually you saw the repricing. But we believe Japan is an interesting one. It's an inflection point. Bank of Japan is clearly behind the curve. And we think actually Bank of Japan need to increase rate once or twice this year. So what you see in the bond market is very interesting. You started to see much more global dispersion. So not all the central banks will move in the same direction. So you might have a Federal Reserve that hold and cut versus Bank of Japan, and probably ECB is going to hike. And that's why it's important to have a global and active approach, which is also shown, I don't know if you heard, but we basically published a fixed income survey where we ask 300 institutional investors the view on fixed income globally, North America, Europe, and Asia. And the trend that emerged is one, they find fixed income still attractive. So 50% of the survey show they want to keep allocation on fixed income, and 25% they want to increase the allocation to fixed income. And the second interesting point is investors, they want to have more a global approach diversified outside the US, including emerging market. So emerging market debt is an asset class that's becoming increasingly interestingly moving more from a satellite asset class into more a core. So this difference between developed and emerging market debt became more and more blurry.
Why is the govie market worried about growth and the equity market or negative growth? And why is the bond market worried about? Let me get this right.
Yeah,
I'll get this right around. Why is the equity market shooting for the stars and the bond market worried about growth?
Well, I can see there are kind of different signals. The equity market is definitely focused on corporate earnings has been extremely strong.
Yeah.
You have this AI that's going to drive productivity for corporates. Actually, we believe that. You can eat these over the next 12 months, you can see impact on growth. But over the long term, growth in the US might be quite strong as well.
Is that deflationary or inflationary?
is the productivity actually is disinflationary.
Okay.
So which
doesn't
is
feel
important.
like that at the moment.
Which it doesn't feel like that. That's why the bond market doesn't feel like that. The bond market is almost pricing a 2022 scenario. We don't think it's the case. And we don't think it's the case because the starting point of yield is also very different. And that's why we find opportunity in the fixed income market now, because it's a different situation compared to a few years ago. But over the long term, very long term, we believe growth in the US is going to be resilient. Inflation might go down in a combination of AI impacting investment, but then also productivity bringing inflation down.
So if AI build-out is inflationary, but then when you get the adoption and the productivity gain, that's deflationary. I mean, it feels like we're going to be in the AI build-out phase, though, for a long time. When you're talking about, companies like, we just got a line coming through from SK Hynix to double memory production capacity over 5 years. Does it seem as if the AI deflationary impulse is still way out in the future?
Well, I think that's why you can see the bond market from two perspectives. You can see the inflation side and the growth side. So you can start to buy bond more as a protection for downside risk on growth, which is one aspect and is not zero probability. So you can see that angle there, which is what we believe more. And you can still buy bond over the long term because you think actual inflation is going down. That's why the case for bond over the medium long term is still the case. What you describe is a situation where the volatility is going to remain extremely high, extremely elevated. And rates, they're going to stay higher for longer. We don't believe rates are going to go back to where we were pre-COVID, but it's definitely an environment where fixed income is going to do relatively well, despite volatility is going to remain extremely high.
And your survey suggests that there's still, people wanting to be exposed to fixed income. Do you talk to clients much about tips? I feel like we don't talk about tips, and there's a lot of inflation around, and there has been, and we still have not talked about tips much. What am I missing there?
Absolutely. I mean, on tips is always an interesting asset class because you need to separate the two components, the break-even versus taking long duration risk. And where we find more attractive today is in the break-even. The break-even is interesting because the inflation, if you look at the tips market, doesn't really reprice this big reflationary environment. So investing in tips through basically just isolate the break-even is an interesting way to protect your portfolio for that potential increase in inflation. So it's interesting because today the way we position portfolio in fixed income is not for just one outcome. You really need to have multiple outcomes. So you buy some duration to protect you from the growth. You can buy some break-even to really protect for the tail event where actual inflation reaccelerate, and this is a kind of a cheap option today.
What's going to happen with the fiscal story next year? At the moment, the US is running a 6%, north of 6% fiscal deficit. That feels unsustainable to me.
Yeah.
What happens to the fiscal impulse next year?
Well, the fiscal problem or issue is not just a US one. It's a global problem.
Sure.
And you can see where we are actually, it's not concern, it's more the impact on the yield, it's more probably in Europe and the UK. Europe is an interesting case where we touched briefly where we believe actually, first of all, the impact of the oil price in Europe is going to be felt more than the US. Europe as a country is more affected by energy price. So that's one, and brings ECB potentially to hike rates. So it doesn't look through the cycle. There is the other side, which is the fiscal impact. And Germany is going to spend a lot of money in terms of expansion, which has an impact on the bond market in terms of issuance. We expect more than 100 billion issue net supply from the German bond, which is going to put more pressure on the German bond side. And so that's why on the relative value, you can see more pressure on the German bond in the euro rates in the long end than in the US.
And in the treasury market. Flavio, nice to see you. Thanks for stopping by to see us.
Thank you very much.
Flavio, Carpenzano, Capital Group Investment Director here on the Fixed Income Story. Tech titans are gathering in Taiwan. The AI boom is, of course, the hot topic of Computex.
I announce his stock price goes up. Nothing happens to mine.
Let's also stay for the record.
I'm very happy about that.
Let's also stay for the record that you were a shareholder and you sold.
Yeah. Well, I needed the cash.
Sort of floating head of Rene House there. Somebody might have thought about maybe the black background and the black jackets. Just putting it out there. That was, of course, the ARM CEO, Rene House, during his keynote speech. There's some news, actually, we'll come to in a moment on that. Computex 2026 is certainly throwing up a few headlines. We'll have more on that story next. This is Bloomberg. Tuesday morning, it's the second. How are you doing? US futures are a little soft. We're not down by much. We're off our lows. European futures are up. We're up 3, 4, 5, 6, 0.7% in some cases. So a more positive picture maybe beginning to emerge. So hard, though, to figure out what is going on out there, particularly with the AI trade and particularly with the oil trade, neither of which look like they're giving us any clarity at the moment, other than we're going to build a lot of data centres and we don't have any oil right now.
Yes, these things seem to be true at the same time. So equity markets, as you saw there from the screen, expected to go higher at the start of European trade play, catch up with the US. Let's talk about today's markets in 3 minutes on the opening trade with Markets Live executive editor who, drumroll please, is in London. Mark Cudmore, very pleased to see you. Thank you very much for being with us on set this morning. So let's talk about productivity and whether you really see a productivity boost from AI. If I were being optimistic, I'd say, look, the last tech trades we got excited about were around social media and the Internet of Things. And we got excited enough about those. And did they really ever threaten to deliver a productivity boom? But maybe AI really will. You're not a believer.
I do think there's a productivity boom from AI, but it's how big of one. We're pricing an extraordinary one. We're pricing that, these companies are all going to make an extraordinary amount of profit in the same overlapping sector, like Anthropic, ChatGPT, Gemini, whichever, XAI. They're all going to completely dominate this space. They're all going to take in a whole load of revenues from all these other industries, even though these industries don't make enough money on the projections to pay all these companies all those amount of earnings. And there's a real productivity boom, but how much of one and how quickly is it coming through? It's really hard to define. I think it's the key question, and when are we going to get that answer? And because that's the kind of earnings rug pull at some point. I think at the moment, there's real earnings being made there, but it's the projections going out that really kind of worry me. So at the moment, I worry that we're conflating the fact that we can produce much more with actually value add, and that's why I don't think we're really getting it.
Google out overnight is going to raise 80 billion, going to get the Anthropic IPO. They're all coming. These are massive risk transfer exercises. How do you feel about them? Well,
that goes into the point that this is such an interlinked system. We've talked about this a lot, right? Where they're all, co-investing each other, co-financing each other, but also the fact is a lot of the incremental improvement in profit of the big, mega-cap techs is the increase in share value of their investments in these other, Amazon's profits get boosted by the fact that its Anthropic share, goes up X percent. And that means that when there's a problem, this is just going to be so bad because, after the GFC...
There is going to be a problem, right, at some point?
There's definitely going to be a problem at some point. But it's right. But after the GFC, we the one bastion of good kind of financial strength were the mega cap tech. They were these kind of cash machines, and they didn't have a massive amount of debt. And now they're suddenly building up their debt. Now, again, they're still pretty strong. There's not a sudden problem about them. But we're suddenly we're really pushing this to the limit. Now, does that push to the limit for another 6 months, for years? I up until about a few weeks ago, I was like, it's at least another earnings season away. And whenever you get to another earnings season, you go, at least another earnings season, because it's going to be an earnings rug pull. But I have to say, I'm no longer as complacent about the fact that it keeps on going forever, because I really think we're just seeing an extraordinary euphoria.
I think that was Mark admitting he was complacent.
Yes. Is that maybe we need to put a pin in that, Mark. We're talking about funding that's going towards, in many cases, data centres that suck in as much energy as a small city. And we're looking at energy. We're looking at Brent right at about $94 a barrel. Yeah. So the Strait of Hormuz is closed. $94 a barrel. Data centres need energy. Increasingly in the US, they're turning to oil and gas. But there seems to be a lag there. I mean, how comfortable are you with the oil prices right now? Should we draw that connection to the AI strike?
Yeah, I'm very uncomfortable because the front contract's not really the big issue. It's the December contract, right? So December oil prices are still above $85 a barrel for December Brent crude. That's more than 35% above the 1 year average price. That is a major inflationary shock coming through. And everyone kind of talks about fibre optic cables from the dot-com bubble, but they had much longer use case, right? These are like chips that are going to have to be usurped by better chips within only a few years, even though we've changed the accounting on that conveniently.
Bloomberg Markets, lovely to see you. What a joy to have you in the studio.
That was him with jet lag. That was a lot of energy for jet lag.
It's even better.
I'm trying to be awake tomorrow. Where's that coming? We all need to bottle that. Bloomberg Markets, lovely to see you, Mark Cudmore, of course. More of Mark tomorrow. You can get up-to-date analysis and insight from Mark and the rest of the less jet-lagged team. Go to MLive Go on your terminal. Let's get your stocks to watch with Chloe Melly. Chloe.
Good morning, Tom. The biotech company Abivax is going to be in focus today after some positive drug trial results. But what's going to be really interesting there is that we actually saw the American shares of that company jump quite significantly and then plunge immediately after. So we could see a similarly extreme reaction in Europe as well this morning. And another key thing to keep in mind is that those results could prompt takeover offers, with one analyst saying that this was one of the most valuable assets in that space. And some of the suitors could include names like AstraZeneca, Eli Lilly and Pfizer. So definitely one company to keep a close eye on this morning. Moving on to a very different sector, and we're going to be talking about chocolate, because Barry Callebaut has lowered its medium-term sales growth guidance. And so this comes just a couple of weeks, a month now, after it cut its profit guidance for this year, for 2026, which sent the shares plunging, as we can see here on the graph. And this is a company that has been dealing with weak consumer confidence and also very volatile cocoa prices. So we'll be watching out for any reaction from the market on this weaker medium-term guidance. And finally, let's talk about BP, because the FT reported that the same person that appointed the chairman, Albert Manifold, who was fired just a week ago, is going to be leading the search for his successor. And so some investors are criticizing this, saying that there's a need for a fresh approach. And so we could be watching out for any potential weakness there as this boardroom drama continues for BP.
OK, that's one drama. Chloe, thank you very much. Much drama to go around this morning, it seems. Chloe Melly with the stocks that she is watching this morning. I'll throw in a couple more. ST Micro on that upgrade to guidance around data centres. And we'll also be watching Prosus on even read across from their holding in Tencent, which has done pretty well in today's session.
With an AI version of WeChat, which is this eponymous super app that's used by almost everyone in China.
You got better things to do now? Where are you going?
I'm off to South by Southwest, London, to moderate a panel with a focus on AI. I'll try and answer some of those questions for you around return on
You'll be back tomorrow with answers.
That is the promise.
OK. Wow.
That was bold.
Okay. That was very bold.
That was very bold. We'll be back with the market open. This is Bloomberg.
Tuesday morning, good morning. Let's talk about Monday before we talk about Tuesday. This was the session yesterday over in the United States. Europe went out here. We've got some more upside. We need to price that into futures. The session yesterday in Europe was negative, so we're going to bounce back a little bit into Tuesday's session. So let me show you the futures, give you an idea of what is going on. This is the picture we're looking at, fairly positive. You've got the Euro Stoxx 50 up by 0.8%. FTSE futures are up by 0.5%. DAX futures are up by 0.7%. There's a few single stock stories out there, but it feels very much like a top-down kind of macro market this morning. You're trying to figure out what is happening with the AI trade. You saw a little bit of caution maybe creeping into the Asian session. You still got an oil story, which is very hard to price. And what happens there, I think everybody's struggling with right now, particularly when it comes to the time factor and when the Strait is going to reopen and when we're going to get some more barrels of oil. All of that is coming. But this morning, at least from a European point of view, from a top-down stage, Anna, we're looking at a positive story.
Yeah, looking at a positive catch-up trade then here in Europe. In terms of that AI trade, which we've been watching as it develops through South Korean markets and into Nasdaq futures this morning, a lot of volatility there. Well, we've got a European dimension to watch. ST Micro nearly doubling its forecast for revenue from its data center business to $1 billion this year. Also talking up the prospects for revenue next year, saying that could also double in 2027. So we watch that. On to chocolate, and the Swiss chocolate maker Barry Callebaut announcing new guidance as part of a strategic overhaul. It's lowered its midterm sales growth range to 2 to 4%. So this under the third CEO in less than 5 years over at that business. And Abivax, this in the pharmaceutical sector, reporting cancer cases in a crucial clinical trial. So that kind of really muddies the waters in terms of what kind of future trajectory we get from this French biotech business. Guy.
OK, here we go. Tuesday session. Let's talk about the equity market open. Let's give you some numbers and show you what is going on. We are expecting it to be fairly positive here in Europe this morning. We're expecting the FTSE to be up by, let's call it, circa 0.5%. So we'll watch that one as we climb towards that kind of a level. Stock 600 could be open 0.6% once we finally get maybe all of those stocks trading. So we're up by 0.3%, maybe a little bit more upside still to come through from that market. The DAX is actually called up by around 0.7%. We're going to watch what happens with the chip story this this morning, the AEX. Maybe we don't get quite such a positive picture coming through from maybe some of the names like ASML, but the CAC is up by 0.6%. The IBEX is up by, let's call it 0.6%. So positive start. We're not up a lot, but we're up. And I think after yesterday's negative session, we're closing a little bit of a gap with the rest of the world this morning, Anna.
Yeah, absolutely. So a bit of positivity coming through then at the start of the trading day, as we expected. Still no opening price on the DAX nor on the AEX, which is interesting with the focus on what we've heard from ST Micro this morning. So we'll come back to the technology sector. In terms of where we see the biggest gains coming through, travel and leisure is the best performing sector this morning. And if I click into that, is it the travel or is it the leisure? It seems to be some of the leisure. Entain is doing well. TUI, though, also. So it's also reflecting a slightly weaker oil price at 94.33. Basic Resources also doing OK, up by 1.4%. Technology doing OK, up by more than 1%. And the ST Micro share price over in Paris is up by more than 5%. So that is certainly something we're watching. They've guided higher, an upgrade to their revenue guidance for this year and for next. So we'll continue to watch that. We also have a movement on the we're waiting for a movement on the Barry Callebaut share price. That one is still not open. The Abivax share price still not open either. So those are other companies that we're watching this morning. Also, Prosus is halted in the Netherlands, and we saw Tencent up by 10%. Prosus holds quite a bit of Tencent, and so often we see those two move on the back of each other. We see Prosus move on the back of Tencent.
So I wondered whether the caution that came out of Asia overnight and the fact that we got futures in the States on the Nasdaq negative would mean that actually maybe some of the European tech story would not do well this morning. But that is not the case. ASML is the biggest points gainer. Siemens, ST Micro, Schneider Electric, all tracking higher this morning.
Yeah.
Those are where the points are coming from first thing.
Yes, and it was interesting, actually, through the Asia session, that tech narrative was evolving quite a bit. And we had seen weakness on the Kospi, then that retraced.
Yep.
But all the way through that, we actually saw Chinese tech doing OK. And I know on the Markets Live blog, they've been talking about whether we're going to see some sort of rotation into that theme. But that's, going to have geopolitical challenges about it, isn't it? But certainly the one that we are watching. So European equity markets then up by 0.5% on the Stock 600 this morning. Let's bring into the conversation Shanti Kelemen, co-CIO at 7 Investment Management, with us on set this morning. Shanti, good morning to you. Thank you for getting in to see us on a tube strike day. Let me ask you about what your view is of equity markets broadly, globally, given the amount of euphoria we see around the AI trade, the amount of money being raised to fund the AI build-out. How are you investing into the AI trade right now, or are you a little more cautious?
We're still quite positive on equity markets. Investor sentiment is quite strong, in contrast to retail sentiment, which is chronically weak. Then we have good momentum, and then on the growth side, you do have higher oil prices, but also the massive amounts of capex we're seeing generally is a good long-term signal for equity markets. I think valuations are probably the main detractor when you look at the outlook for equity markets, but that's kind of outweighed by those other factors we see right now.
And so, which sectors are you particularly enthused by? If you're still into stocks, so whereabouts in particular?
So we run a sector strategy, and in that we have more in information technology, and we've recently increased that. We also have a fairly large exposure to communication services, which are both very much front and center in the AI trade. We have a bit of energy in that as well, which came in kind of March, April time, in response to that. But I think when you look at those sectors, you see strong earnings revisions upward. You see the actual earnings coming through. And then you also see, there's high capex from some of those companies, but then that's cycling back into the hardware providers and kind of providing that certainty of buying power out into the future.
You like the energy sector, but everybody seems to believe that the crisis in the Gulf is going to be over soon. Presumably, won't oil prices come down fairly dramatically? Won't oil stocks come down fairly dramatically if you believe that the situation is about to be resolved?
So I think there's the short-term issues we've got there. There's also the longer-term demand for power related to AI. Okay. And I think that is something, maybe we will, yes, oil prices will fall if the Strait opens up. But longer term, you have a lot of demand that's going to need to be met if we're actually going to be running it. We get a lot of innovations to try to run chips with less energy, but I don't think the volume of compute that some of these companies want to do, we're not going to get there without more energy.
Talking about those companies that want to run that kind of level of compute, a lot of them are about to come to market. What do you think about these IPOs? Should investors be buying them? Does this sort of portend some sort of signal for the market? It's an awful lot of equity coming out. It's a huge risk transfer exercise. They're going into the indexes. What do you make of this process and what the signal is from it?
Yeah, I'm a bit reticent about the exceptions that have been made to put things into indices straight from the get-go, because that's never been done before, and it doesn't give a lot of those passive investors the choice or the certainty of having stuff that's in the index be things that are tested. Certainly a lot of enthusiasm. I think there probably is enough capital out there to fund it, but I think we're certainly going to have a negotiation period on how much people are actually willing to pay for those. And I think right now what you're seeing is, testing the market to see what the demand is, where the valuations will go to.
Yeah, Shanti, just as a test case to understand how it affects investors' thinking, I mean, how will it impact? You talked about having in your sector modelling quite an exposure to information technology, which I assume will include some of these companies. So how will you have to respond to these big listings? Will you have to remove some of the exposure to IT elsewhere to avoid going too overweight tech, or is that not going to be a concern?
Yeah, so with the analysis we've done, we think if you do get, the three big ones in, you probably end up with something like a 5% weight in the S&P 500, which is significant, but not, it's not like it's going to 20. Yeah. So we'll have to, a lot of the stuff we do works on earnings estimates, momentum, those sorts of things. You won't have a lot of that data for those companies to begin with. So I think it'll force people that run some of those more quantitative strategies like us to have a little bit more judgment, because we simply won't have that until we have a few quarters.
I was going to ask you about alternative strategies, because you talked in your notes ahead of our conversation about selling put options, about relative value FX trades, and I wonder what's dictating the kind of alternative strategies and how much you're leaning into those at this point.
Yeah, so those worked really well for us in March, and I think our view is we'd rather have strategies we can test and understand than own things like infrastructure or real estate, which can often behave the same as normal markets. I think things like put selling is just a chronic thing where the market overprices, that hedging risk. So if you're willing to take the other side of it, you can make a quite good return. And the other things like FX can be quite uncorrelated to other parts of the market. We've also seen trend perform really well this year. It had a bit of a weak patch last year with the tariffs, but this year has been a lot stronger. So it's just about finding things that are actually diversified rather than optically diversified.
Yeah. So what is it that the rest of the market worries about that you don't worry about, that you're able to take the other side of that put trade?
So I think there's a lot about structuring about how you do the options and what volume, in what size, over what timeline. So that is really important. And I think you also have to accept with those strategies that there's a window where you outperform, and then be aware of the market conditions where you'll underperform, because it will happen in certain market environments, a sharp crash or a really sharp rise.
How correlated is Europe to all the kind of big technology stories that you've talked about so far? Can I hide in Europe? If there was to be a downdraft in tech, is Europe going to do well, or is it going to be just an outperformance relatively? I am still going to lose money on that trade.
Yeah, I think Europe has, Europe's share of tech has improved a bit, where you have, these companies like ASML, SAP, Micron, Infineon. So I think that has improved. A lot of it is still, still high exposure to energy, still very high exposure to consumer. And I think it's suffered from being on the weak end of that quality growth trade, which hasn't worked very well. And I think the other thing Europe will always struggle with is it's just a more highly regulated environment than somewhere like the US, and that imposes more costs on business and makes it a bit harder to grow.
You don't like Europe by the sounds of things.
It's not my
favorite. From an investment point of view.
I think there's some great companies there, but as a whole, I think they probably need to do a bit of work on capital markets and regulation.
I've heard that before.
Can I ask about Asia with a view to tech? Because we're just getting this red headline crossing the Bloomberg terminal now saying SK Hynix to double memory chip wafer capacity over 5 years. Seems to chime with some of what we were hearing a little earlier about them investing in what might be a structural change or might still be part of a cyclical environment for chip companies. We'll wait to see. But what are you doing around Asia? And how do you think about investment in Asia tech? Because we've also got more than 40 companies in the Hong Kong pipeline waiting to come to market in terms of Chinese tech, and a lot of that is robotics companies. I mean, how are you thinking about where the next leg is going to be in the AI tech gains?
Yeah, I think emerging markets has almost become an AI trade to some degree. And what's quite different is we usually had this dynamic where when US didn't do as EM and US were a little bit uncorrelated in that they were different, and I think that's converging more and more. I think EM, there's still the problem with it is you bundle together all these different markets that do very different things. So as the markets get bigger, we're able to cut them up into pieces a bit more to actually invest in those specific themes. Asia certainly has production capacity that doesn't exist anywhere else in the world is going to be absolutely critical to that. And I think when you look at a lot of these orders, there certainly is demand for that, that growth in memory.
It's going to be interesting to see how cyclical the chip industry still is, if we're going to build a lot of capacity. Shanti, nice to see you. Thank you very much for stopping by to see us. Shanti Kelemen, co-CIO at 7 Investment Management. Thank you very much. Core 6 looks like this morning. Tech certainly playing a big part in the narrative. As you can see, you've got Schneider doing well. ASML is doing well. Prada, just pay attention to that. That's just having a ripple effect into the wider luxury space. Nestlé's a little softer on the consumer front. There's a chocolate story this morning that is always worth focusing on. Anyway, let's turn our attention to what else we're watching. Let's get back to the chips rather than the chocolate. Chloe Melly is here.
Good morning, Guy. Indeed, we are seeing ST Micro up almost 10% this morning after raising its forecast for data center revenues for this year to about $1 billion. And that is compared to a previous forecast of nicely above $500 million. So this is a huge boost, and this really contributes to this overall AI optimism, AI enthusiasm that we have been talking about for some of those European chip stocks. And so we are seeing a big boost this morning for ST Micro. It's also an AI-related story for Prosus, which owns about 20% of Tencent, and Tencent shares have advanced quite significantly as well on reports that it is testing a prototype AI agent. And so this is really confirming this, the fact that it is working on those AI efforts. And so we are seeing Prosus benefit from that as a result of its shareholding, and we're up about 11% this morning. So a big boost there as well. Moving on to a very different sector, the supermarket sector, with the whole delays down this morning after Goldman Sachs cut the recommendation on the stock, citing some challenges in the U.S. market, where there are challenges related to the food assistance program, and also there are slowing retail sales in that region. And so this is impacting whole delays negatively, and we are seeing that reflected in that weakness in the shares this morning. And finally, let's move over to the steel sector, because we have Morgan Stanley upgrading Salzgitter this morning and saying that there are opportunities there from the new steel regime from the European Union, which is reducing import quotas, and that could really support pricing for that company. And so we are seeing that upgrade reflected there, with the shares up almost 8% for Salzgitter this morning.
Chloe, thank you. Chloe Melly with the stocks that are moving. It is Tuesday, the 2nd of June. 12 minutes past 8 then. So we see these... I was going to call them modest, but, 0.7%. That's not all that modest gains on the Stock 600 this morning. Coming up, it's one of the largest equity deals of all time. More on Alphabet's plan to raise $80 billion to fund its AI spending plans. That's next. This is Bloomberg. Welcome back to the opening trade. We are 16 minutes into our European equity market session, and we've got decent gains coming through across European equity markets. A host of factors. One is just catching up with some of the gains on the US session yesterday. But there's also some optimism around tech, and it's had a volatile session in the Korean market. But into Europe, we've got some positivity around some tech themes. ST Micro is one of the businesses that is on the rise this morning, and they've upgraded their guidance for revenue out of data centers for this year and then into next. Prosus also on the front foot. That's a read across from the Chinese market, where Tencent was up really strongly, agentic AI in focus there, and Prosus holds a big stake in Tencent. But we're also watching this filter through into other parts of the chip-making space. So Infineon is stronger, up by 5%. This is a positive day for technology stocks, then, guys.
Not biotechnology companies, though. Abivax is down really sharply on the back of a trial related to a bowel disease trial, which is being complicated by cancer, according to the latest reports that we're reading. Anyway, it will complicate the path of that drug to market. So that stock is down pretty sharply. But let's talk more about what is happening in the tech space. Alphabet, 80 billion raise. Equity we're talking here. This isn't debt. This is a package of equity offerings. 40's going direct to consumers. You've got 10 going to Greg Abel over at Berkshire Hathaway. You've got another 30 that's split into two tranches, 15-15. The move comes amidst AI funding spree, which is huge. And you're now starting to see some of the big companies within that space potentially talking about going to market. Anthropic apparently has privately filed for an IPO. OpenAI will not be far behind. Let's talk to Bloomberg intelligence analyst Matt Bloxham. Matt, let's start with Alphabet. This is the company that used to throw off cash, that used to buy back stock. It's now selling stock. It's now selling debt. How different a business is this, and what does this 80 raise tell us about its trajectory?
Yeah, I mean, the big difference here is clearly that we're still in the midst of this massive AI spending bubble. And, as you said, this company generates a huge amount of cash, trailing 12-month basis, over $170 billion. But this year they're going to spend $180, $190 billion on investments, mainly in AI infrastructure. And the year after, they're saying it's going to be significantly higher. My colleague Mandeep Singh in the US thinks it could top $300 billion of investment next year. So as much as it's generating a huge amount of money, it needs more to kind of fund this growth. And, we are in the middle of an AI arms race. We've got Anthropic, we've got SpaceX, we've got Meta, all these companies, Anthropic, and these people, you want to get your infrastructure out there. And there's a kind of scarce supply of resources. A lot of this investment that Google's making is going to go into making their own chips, a very vertically integrated business model. So they need the money.
So some of it's about competition with NVIDIA on the TPUs, its own chips, as you mentioned. Some of it's competition with other AI models, the likes of Claude, and that takes us on to Anthropic. So what have we learned then? I mean, this was this private filing, or a fairly secret filing at the moment.
Yes.
But why now? Why is Anthropic in this race with OpenAI right now? And is it a race? Is that the right way to describe it?
I think it is a race. It's a race in many different perspectives, Joanna. I think clearly the Anthropic filing, clearly the first step towards an IPO. This has been very well signalled. I don't think it's a big surprise, but the interesting tension here, a few months ago, it was just, who's going to file first, OpenAI or Anthropic? Clearly, Anthropic's got there first. They've got very strong revenue momentum right now, so it makes sense for them to try to get there first. Capital is scarce. And now you've got SpaceX looking for $75 billion of IPO funding. You've got Google looking for $80 billion, and now you've got Anthropic and potentially OpenAI. You don't want to be the last person coming to market asking for money, because there may well not be that much left, or the terms on which you can get it may not be quite so attractive.
One of the big debates right now is the memory market still cyclical, or is it not cyclical? SK Hynix this morning coming out and saying it's going to double capacity, which it's like the base is already large, but it's going to double capacity over the next 5 years. Is a doubling of capacity going to be too much or not enough?
I mean, that is the $64 trillion question, maybe. And I know Ed Ludlow was asking this question yesterday of Jensen Huang, and I think clearly there's a huge amount of optimism. We don't know, but what I would hope is that this company is building that capacity in a very modular way. So to the extent that if this does turn out to be a kind of a temporary peak, that they can actually pull back and not double it, but maybe kind of modestly increase it. But I think it's a clear signpost of just how tight supply is right now, and just how much demand is coming through. Like you get the sense that we haven't reached that kind of short-term peak demand yet, if they're talking in terms of doubling capacity.
There's so many different strands to the tech theme this morning, all AI related, of course. And overnight, we haven't even talked about Hewlett-Packard. Shares soared more than 20%, I think, after hours, didn't they, on the back of their results? And I'm put in mind of that story we wrote recently about iconic tech names of the sort of 90s and decades past. What does this HP story tell us?
It tells us that the AI deployment story is entering a different phase. So obviously the focus historically has been around NVIDIA and their training chips. And actually, as you go into corporate deployment of AI, a lot of kind of more straightforward servers can actually deliver the performance you need to do the inferencing and deployment of the applications. And that's a great opportunity for HP Enterprise, and also we saw last week with Dell. And so specifically with HP Enterprise, guiding to a kind of a 31% increase in revenues this year, and I think it was something like 10% next year, which is almost double what the market was expecting. So, as enterprises demand more infrastructure to kind of run their AI models, this is playing into the kind of more traditional server makers.
What do we know about that end user demand? At the moment, companies are kind of trying to figure out kind of what does AI do, how do I use it, how do I deploy it properly, how much is it going to cost me? Are we getting the rate of return that corporates need in order to justify the expense, because the expense is substantial. You look at the cost of building this stuff, it is massive. Therefore, the cost of kind of running this stuff is going to be substantial as well. These companies are going to need the end user to pay up. And if the end user is going to pay up, it needs to have a benefit. And that's the bit that I think people are still struggling with.
Yeah. And I think most CFOs are struggling with that. They don't really know how to calculate the return on AI investment. I think there's just a sense that at some point it is going to deliver a return. I think most companies that are going all in on AI right now, it's actually increasing their overheads, not reducing them, but they're hoping...
It's inflationary at the moment.
Exactly, yeah. And, and I think that, but there's an expectation that they can see that in some certain use cases, there is a deflationary opportunity or a productivity gain opportunity, and that ultimately, whether it's a 1 or 2 year view, that will balance out. But that is the real kind of issue that's going to determine whether this is an AI bubble or an AI kind of sustained boom, is whether enterprises and the CFOs do start to see that return come through, because you can't continue to run with higher overheads for any more than maybe a 6 to 12 month period. If you're a public company, that's going to squeeze your margins, and shareholders going to put you under pressure. So something's going to have to give, and I think that is a massive outstanding question, the ROI question.
And so maybe it makes the next question impossible to answer, Matt, but we were talking to Mark Cudmore from the Markets Live team earlier on, and he was saying he's worried about a kind of double counting of earnings estimates. So this isn't the earnings they're getting now and the revenues they're getting now, which are in some cases impressive. But when you go out into the future, if they're all looking at how big is the addressable market and how big could we be in that, is there a sense that there's a lot of companies going after the same revenue, perhaps, and that they won't all get it?
I think that's absolutely right. And you see that very clearly in the SpaceX IPO filing and the $28 trillion market opportunity. When you actually kind of look into the detail of that, there's a huge number of players in each of those markets fighting for the same end user revenue. And actually, implicitly within that, there's probably actually a lot of revenue passing between different players. So at some point, it's going to come out in the wash. And there's so many people investing right now. It's difficult to see that all of these players are going to be truly successful in addressing the opportunity.
Okay, Matt, thank you very much. Thanks for briefing us, giving us a full briefing on some of those tech themes. Bloomberg Intelligence analyst Matt Bloxham. So, guys, you mentioned we're having a good day for European tech, but not a good day for European biotech in the shape of Abivax. That stock now down by 28%.
Quarter of its value. Third of its value nearly wiped out on this drug trial news that we are getting. We're going to take you back to what is happening with the oil story next. We'll park single stocks for just a moment, and we're going to come back and figure out exactly what is going on with this oil story. Very hard to price right now. Very hard to get a handle on what the timeline looks like right now. Angelina Valavina, head of EMEA Natural Resources at Fitch, is going to be joining us very soon to update us, give us her thoughts on when she thinks we're going to see some clarity maybe emerging, some pricing clarity emerging. We'll do that next. This is Bloomberg.
This is the opening trade, 30 minutes into Tuesday's session, and European equity markets then very much on the front foot this morning, up by 0.6%. And some of these markets doing really well. The German market, the French market, up by 0.8%, as we see higher expectations for what technology can deliver in Europe. That's in the shape of ST Micro. A bit of read across from the Asia technology session. That's in the shape of Process going higher. And in fact, Guy, we've got most sectors in positive territory here in Europe. There are some in negative territory, and that partly explains why we've got the FTSE 100 underperforming a little bit today.
Energy's under a little bit of pressure. That's a factor when it comes to what's happening with the FTSE. Broadly, though, 455 up, 136 down. We are definitely on the front foot when it comes to Europe, despite the volume picture. Let's talk about where that is coming from. It is definitely coming from tech. Process is up on the Tencent story. Infineon is up more broadly on what is happening in the chip space right now, despite the fact that we are seeing SK Hynix talking about doubling capacity over the next 5 years. You got SAP starting to see maybe some of these software companies working their way through the SaaS apocalypse narrative. SAP is up by another 1.6%. So tech is the driver in Europe this morning. You are seeing some weakness elsewhere. So biotech is under pressure. Abivax is definitely down. Take a look at its stock, down by 26% this morning on the back of a drug trial that doesn't look quite as positive as maybe the market had hoped for. Bayer is also softening up a little bit. And I also think some of the consumer stocks are down a little bit as well, which I think is interesting. Some of the more defensive stocks. You look at what is happening in the food space, a little bit of pressure there. Look at what is happening in the tobacco space, a little bit of pressure there. So definitely we are looking at the tech story much more positively this morning here in Europe. We have some tech. It is up. The defensive names, which we have a lot of, are under a little bit of pressure. Net, though, the market is higher, Anna.
Yes, absolutely. Let's get up to date on some of the other stories that we need to know this morning. NVIDIA CEO Jensen Huang says he pays his workers, quote, as much as possible. Huang made the comment when responding to a question about Samsung and its recent compensation agreement that will deliver bonuses of as much as $400,000 to some chip engineers. He gave his view amid a growing global debate about how profits from the AI infrastructure boom should be shared. One of the world's most prominent short sellers, Andrew Left, has been found guilty of securities fraud by a US jury following a closely watched trial. The Citron Research founder was convicted on 13 of 17 counts and could face more than 20 years in prison, with sentencing set for August. The case marks a win for the Justice Department and puts a spotlight on the practices of activist short sellers. And Bloomberg has learned that the European Commission is weighing plans to grant member states additional fiscal flexibility to cope with the impact of high energy costs due to the Iran war. The proposal under discussion would allow governments to spend around 0.3% of GDP on energy-related spending outside the EU's fiscal framework. Guy.
Anna, let's talk about an area we haven't talked about for a while, which is what is happening in the banking space, particularly the ongoing saga surrounding UniCredit and Commerzbank. UniCredit this morning updating on its offer for Commerzbank stock, saying that it now has commitments as part of that offer to take its stake in Commerzbank well above 30%. Now, that obviously gives the whole story a little bit of momentum from Andreas Orchel's point of view. Shareholders have attended enough stock to increase the direct stake from 26.8 to north of 30, well north of 30. This is according to people familiar with the matter. So this gives Orchel influence now, much more influence in terms of this process as it unfolds, which feels like it's accelerating. Still got a couple of weeks to go in terms of this offer that is currently out there, Anna.
Yes, I mean, this is a saga that just rolls and rolls, doesn't it?
Yep.
I mean, starting out as a fairly small shareholder, but right from the start, the reception from the German government around this was very negative, wasn't it? It was as much about the style of the approach, the way that this stake has been accumulated, it would seem, that the German government did not appreciate. And so we'll see whether any of this, whether the time passing mends any of that relationship, because it would seem as an important stakeholder to have on board if you're trying to buy Commerzbank would be the German government.
So that was a nice little foray out of our two main subjects that we spend most of our time talking about at the moment. It's nice not to talk about AI or oil, but we're going to do that story now. Back to the oil story. Ticking lower a little bit this morning. We've had a pretty big gain, though, over the last few days, and largely that is holding up. President Trump and the Israeli Prime Minister Benjamin Netanyahu apparently offering differing accounts of a call that they had regarding the fighting in Lebanon. Now, Lebanon's critical because Iran indicating that is absolutely pivotal to its outlook. Iran saying that Lebanon must be part of a broader peace deal. Let's discuss all of this uncertainty and what is happening in the Gulf. Angelina Valavina, Head of EMEA Natural Resources and Managing Director at Fitch Ratings, joining us now. Good morning. Nice to have you on the show again. Let's talk about the timeline and where we are. It's a great pleasure. When do you think the Strait of Hormuz is going to be open?
It's a very good question and a very difficult one. So our current assumption is that the reopening will take place in July. And this is what our current Brent price assumption is based on, which is $87 per barrel for Brent on average for 2026. As I mentioned, there is a lot of uncertainty in terms of the peace deal negotiation, the timeline, and also what it will entail. But the most important bit for the oil markets is the Strait of Hormuz. The reason why we made this assumption about July is because this is the timeline where several factors will meet together and might influence this timing. So one is obviously the driving season in the US starts in May and it will peak in July. The second point is the US GDP economic data, inflation data for the second quarter will be published around July, August. Obviously, there are midterm elections in the US. But another important factor is China, because China currently has oil reserves of 1.2 billion. And it used to import about 5 million barrels per day through the Strait of Hormuz. They transited through the Strait of Hormuz. And if those reserves that the country has are sufficient to cover those imports through the Strait of Hormuz up until the end of October. So the confluence of these factors might mean that the Strait of Hormuz will be reopened there around that timeline.
Around that timeline. What is your degree of certainty that that will happen?
The risk is binary. This is how we look at it. If it reopens earlier, then the price will be lower, because we do believe that the key bottleneck in terms of the price dynamics is the Strait of Hormuz, and in terms of the risk premium. If it reopens later, then the price will be higher. But as I mentioned, the risk is binary. It's very difficult to predict it.
Very difficult to predict, absolutely. And I wonder if the nature of the deal that reopens the Strait, Angelina, has any bearing here. We spoke to a guest yesterday who talked a lot about the possibility for what she called a muddy deal, meaning that not everything will be resolved, not everything will be, there won't be a solution to everything, but maybe the Strait reopens. But does that put us into a position where the threat of reclosure of the Strait hangs over the market and therefore elevates prices?
The degree of uncertainty will remain high, and that's why the geopolitical risk premium will stay in the oil price. So our current assumption is that if it reopens in July, then the price on average will stay between 100 and 110 in May and July. And then it will fall to around $80 per barrel in August, and then to roughly $70 per barrel from September. And that's the time when it will reflect the levels which are implied by the market fundamentals, so supply and demand, but will still retain the residual geopolitical risk premium. The reason why we believe that the price will fall quickly and sharply is three. One is that we expect the production in the Middle East to ramp up very quickly to sort of near normalized levels. The second reason is there has been no material damage to the oil infrastructure in the region, at least so far. And the last reason is the supply response, non-OPEC supply response, has been quite strong year to date. And we do believe that the OPEC supply response might be quite strong after the reopening of the Strait of Hormuz. And the production will ramp up not only to the level which was before the war, but up to the maximum production capacity of OPEC, which used to be 3.6 million barrels per day.
Angelina, can I ask you about physical crude if we don't see the reopening? So accepting that your base case is that we get that reopening in July. If we don't see that, when does the inventory story start to look really unsustainable, and when does that take off as a narrative that will then come back and really influence futures prices?
So in terms of the oil stocks and inventories, we started the war at 8.2 billion barrels, which is quite a substantial number, and it is more in line with what we've seen at the end of 2020. There was, the IEA announced a drawdown of 400 million barrels, so we will be down, let's say, to 7.8 billion once the drawdown flows into the market. And then again, if the Strait of Hormuz remains closed until July, we do not anticipate another release, but it is not impossible because we've seen 2 releases of reserves in 2022. So there is a precedent for that. But overall, 8.2 billion are more than sufficient to cover all the volumes which transited the Strait of Hormuz before the war for over a year. Then going back to the point of the Chinese reserves, because the key importing countries through the Strait of Hormuz were Asia, and China was the main one. China, India, and quite a few other countries. 91% of the oil which transited the Strait of Hormuz went to Asia. So if we look at the Chinese oil reserves, it's 1.2 billion, and they are sufficient to cover their volumes, which they bought through the Strait of Hormuz up until the end of October. That's, from our point, is a very important issue and a very important point to consider.
Okay, yeah, really interesting then. The stockpiles could take us for another year at some level. Angelina, thank you very much. Thanks for joining us. Angelina Valovina, Head of EMEA Natural Resources and Managing Director at Fitch Ratings. Let's move on to other news. At least 11 people have been killed across Ukraine as Russia carried out large-scale drone and missile strikes. The overnight attacks come as Bloomberg learns that Russian finance officials have warned President Vladimir Putin the nation's war spending is on an unaffordable path. We're joined now by Bloomberg's Tony Halpin, who leads our Russia economy and government coverage. What's the latest from the overnight strikes? Take us through the level of escalation that we've seen recently then, Tony.
Yes, this is the second, what Russia has called sustained strikes on Ukraine, and in particular Kiev. There were more than 70 missiles, more than 650 drones. And it's quite noticeable that while Ukraine is really quite successful these days in knocking out drones, they're having less success against ballistic missiles, and that's in part because they are struggling to find sufficient quantities of air defense missiles to support their own air defenses. Very large scale, as I said. Russia has threatened these strikes in the last 10 days, and this is the second of them. And so far it's ignored US and European warnings against doing these kind of things.
I'm reading a lot at the moment about the fact that there is growing pressure in and around the Kremlin regarding the cost that this war is imposing on Russia and the Russian economy and the Russian people. How severe are the differences within the Kremlin? How could this unfold?
Well, there are two clear blocks. There's the finance, the economic bloc, which is making clear that the price is growing ever more heavy on Russia. The budget deficit already is bigger than the whole of last year, and growth has slowed practically to zero. 0.4% is projected for the whole of this year. They've just slashed what was a fairly meagre projection in the first place. But on the other side, there's the defense ministry saying that they want billions of dollars more in spending because they want to prosecute the war, and they're assuring President Putin that his war aims will be achieved. So there's this struggle going on. Putin's in the middle. He's not indifferent or unaware of the difficulties that they face, but he's very clear, I think, that it's somebody else's problem to find the war money that he needs for the invasion, and he intends to prosecute it without any changes. We will see how far that develops as the year unfolds.
Yeah, and do we get a sense of whether this path then of war spending is sustainable, Tony? I mean, oil prices are considerably considerably higher than they were just a few months ago. There are limits, of course, to what Russia can earn selling to certain sources, but there's a lot of demand out there for energy products.
Yes, I think Russia doesn't really feel that the increase in oil prices is going to make that big a difference. It would have to be over $100 a barrel for more than a year, really, to help ease some of those pressures. So there's no doubt that this tension is going to continue throughout the year, and Putin is going to have to face the consequences of that in the discussions with officials. But the question is whether or not that changes his calculations in regard to the war. So far, he's showing no sign that he's ready to do that. But if those pressures increase through the year, if the domestic discontent in Russia over some of the consequences of the war become more visible to the Kremlin, they have elections coming up in September that they need to manage in some way, then that calculation may change. Certainly for now, at least, financial officials are simply saying, look, the pressures are getting bigger and bigger. It's getting harder and harder for us to maneuver here. Something's got to give.
Tony, thanks for the update. Greatly appreciated. Tony Halpin joining us on the latest out of Moscow. Serbia's president, meanwhile, has pushed back on accusations of being a Russian puppet and has defended his warm ties with Xi Jinping. During Aleksandar Vučić's 12 years in power, he has positioned Serbia as a conduit for China and as an ally of both President Trump and Vladimir Putin, despite a cooling since the full-scale invasion of Ukraine. Fresh from a recent visit to Beijing, Vučić spoke exclusively to Bloomberg's chief Europe correspondent, Oliver Crook, in Belgrade.
For us, of course, of an utmost importance are their investments and their commitment to work together regarding our steel mill, regarding our Zijin mine in East Serbia, copper mine, and new investments in brand new and cutting-edge technology smelter, which means nothing to me, but I was doing my best to learn everything from them about it, and that's it.
And so you have the economic part of that relationship.
Yes.
There is, of course, the geopolitical element of that, and there's obviously some objections from your European partners, potentially also increasingly from the Americans. Is there a limit, do you see, to that relationship, that partnership with China for the sort of practical purposes of geopolitics? Did you, for example,
if you ask me,
fighter jets from the Chinese?
I'll respond to you. I'll respond to you in a bit different way,
sure.
Maybe even unexpected. Instead of justifying myself, would like to, because there is nothing to justify, because I was doing my job, as all the others were doing their job. We Serbs, we don't have a big factory close to Chongqing, or Chongqing as we say, or anywhere else in China. But yes, Europeans were saying to us, okay, you need to organize a tender procedure, transparent procedure for that copper mine in East Serbia. We'll find some companies and they will bid for that. And at the end, the only real offer that we got was Chinese offer. Just to continue about it. Everybody was saying, okay, you were Russian puppets, you just wait for the very best moment to attack your neighbors in the region. Of course, it didn't happen for almost 5 years, but no one had never apologized to us. At the end, now it's not anymore about Russia. Now it's becoming more about China. Now don't go to China. Next time, if I go somewhere else, they will say, don't go there. And I don't accept this kind of lists, and my job and the job of my team and our government is to take care of Serbia's interests, not the other people's, not the other countries' interests. And why I'm saying this, because in the last 5 years we didn't open a single chapter, a single cluster. What do you expect from us?
And on the question of
to die silently?
And on the question of EU accession, how do you see the progress going towards that? You said you wanted to meet all the criteria before the end of this year. Are you still on track for that? Do you find that there's the political will on the European side?
We do a lot of work.
Serbian President Aleksandar Vučić speaking there with Bloomberg's Oliver Crook.
And speaking of the geopolitics, which she was referencing a lot of there, later today we'll be hearing from the Norwegian Finance Minister and the former NATO Secretary General, of course. That is Jens Stoltenberg, that conversation from Oslo. You can catch that exclusive 45-minute Bloomberg Newsmakers conversation live on Bloomberg YouTube and Live Go channels. That's at 3 p.m. UK time.
OK, let's talk about what's coming up. Economic data out of Europe and the United States a little later on today. Also, what can you be expecting from these numbers? Which one should you be focusing on? The JOLTS data for a while certainly captivated our attention. How useful is it now? What's happening in the labour market? Inflation front and centre, certainly here in Europe. CPI readings coming up later this morning. How will the ECB react to that? We'll discuss it all next. This is Bloomberg. OK, welcome back. Let's take a look at what is going on. We are 52 minutes into the session, and actually things continue to look even more positive than they did at the open. We continue to climb. Tech is the main driver of this. You've got names like Infineon and Prosus all doing quite well today. Even SAP's having a fairly solid session. So you're getting outperformance coming through from the French market and the German market.
Absolutely. Let's think about some of the things we're watching for today. In about an hour's time, just over, we'll get Euro area CPI, so that puts the inflation story front and centre. Thinking of which we will be focused on the Bank of England story at 2 o'clock UK time, when the Governor, Andrew Bailey, will be speaking before the House of Lords Economic Affairs Committee. Then we turn to US data, US JOLTS due out later on. That's early afternoon UK time, of course. We'll also get US congressional primary elections. They're being held in California, Iowa, Montana, New Jersey, New Mexico and Dakota. That's a long list. And, of course, we will be watching everything that's taking place in Lebanon. Israel and Lebanon resume talks in Washington, D.C. We'll see what's happening on the ground at the same time. But let's get back to the markets.
Let's talk about the data. JOLTS data out a little bit later on. Job openings, very lagging indicator in terms of what you get in terms of that data series. We're also going to get CPI out of Europe. If you're the ECB and your job is to make sure inflation doesn't get out of control, is this going to be enough inflation to signal a rate hike? Let's try and get an answer to that question. Skylar's here to do it. What do you think?
Yeah, I mean, I think the clear answer is yes.
There we go. Job done. Moving on.
Well, we have the regional inflation numbers as kind of a precursor, so we have a pretty good idea by the time the European number comes around what it's going to be. The expectation is 3.2%. That's clearly
more than 2.
More than 2. And I think the idea, as well as we head into next week's ECB meeting, is that officials are thinking if you don't hike at this point, it's a monetary ease, because that's what the market expects. You know that oil prices are still much higher than they were in 2025, so that inflation will continue. Even if you look at 4Q26 commodity prices in terms of the futures curve, which is backwardated, that's still significantly higher than 2025. So there's a credibility component of, even if they're worried about the demand side of the equation, about growth, they should hike at this point. I think the real question is, when does that second hike come? Because that's what the market's looking for.
There is going to be a second hike?
I mean, it's very much what's priced in. I'm a little bit more skeptical, but I think you need to see demand deterioration before the market turns away from that.
We talked to a couple of guests earlier on in the programme, Skylar, who came at things from a fixed income perspective, and both of them seem to be putting more emphasis on the growth dynamic than maybe expected. Maybe that's obvious if you look at fixed income and you're preoccupied by what's going on with oil prices. What will we learn about the growth dynamic from JOLTS data, from the things we're going to hear from the US data picture this week?
Yeah, I mean, absolutely. We've seen so far that the US economy has held up with this resilience. We got ISM manufacturing yesterday, and it was a very similar picture where your headline number was higher than expected, and it rose further into expansion territory. Importantly, though, you also had the employment number come out strong. Prices paid was a little bit below expectations, but it's so high that, you can kind of put that on the back burner in terms of not really being a disappointment from an inflation perspective. And we'll get jobs data through it this week that I think just confirms that. So JOLTS later today is expected to come in line with the previous print. What I'm really watching for later this week is the unemployment rate, because that's what the Fed's watching. But the key message from that is, if growth remains resilient, then equities can keep rallying, and it means that the Fed can focus on the inflation mandate. Now, further out into the year, I start getting more worried about growth and demand destruction. I think particularly for Europe and the UK, that's a really big concern. If you get these hikes, particularly in the UK, where the idea was they were above neutral previously, you need to start considering that from a fixed income perspective.
Okay, Skylar, thank you very much. Skylar Montgomery-Coney from the Markets Live team. 8:56 here in London, and we're all at work, so that's great.
Should we have a quick look at the people that are not at work yet?
Not yet at work, yes, because there is a tube strike taking place today. Not all the lines are closed, but some of them.
No. So outside, there's a number of things going on, one of which is it's raining. And you can see the umbrellas, which is never good. If you're going to have a tube strike, at least make it on a sunny day. So
that would help, wouldn't it?
Cycle to work.
I think I might just find somewhere to sleep here, at work. Maybe that's the solution.
We're going to
find
Anna tomorrow morning under her desk.
Yes, under this desk, perhaps. 8:56 in London, then we will hand over to the Pulse. That is coming up next. European equity markets actually doing pretty well, up by 0.9%. Tech, a lot of themes to focus on there. This is Bloomberg.